Hello and welcome to Weekend Investing Daily Bytes. We are shooting episode 254, and today's discussion is about dealing with high inflation. I think it's pretty accepted now that we are in an inflationary environment and this inflation is not going away anytime soon. So, what can you do to sort of protect yourself and be in the right asset classes while we deal with this inflationary period, which may be very long? I mean, in the 70s, 80s, we've had very long inflationary periods, and once inflation comes in, it's difficult to kick it out. Even though, let's say inflation was 6% this year, and next year the government has been able to tame it to 3%. Prices have moved up. So prices have moved up, everything else has moved up, and only the rate of change for the next year has muted a little bit, which can come back again in the third year. So from that perspective, only a very deep recession or a very long slowdown can really eliminate all those excesses that can be there. And with the currency printing that is happening, I think in every currency, not just the US dollar, that of course is the major or the sole reason for inflation. All these other reasons of supply constraints, etc., are weak reasons. The main reason is the supply of currency and the availability of money at cheap rates. Nevertheless, we had a very good start in the morning. Nifty was up more than 1%, and everything was looking really good. But towards the middle part of the day, there was a sharp reversal, and all the gains of the morning were given up, and some lost as well. So IT, private banks, autos, real estate gave up a lot of ground. Nifty itself closed nearly 0.1% down. Energy and metals retained some of the gains of the morning, but very mildly so, so 0.3 to 0.6%. So very, very confused market again. We are hovering around 15,800. We had reached 16 plus, but we are now back to 15,800, and we are only, I would say, 4% or so away from the recent lows. So any small bump or any headwind that we get from overseas, we'll again go back to those lows and lower perhaps. So and we are very near the result season, so that also has its own pushes and pulls as the results will come out. So it's going to be, I think, choppy. That's just a guess that I have. It's going to be choppy for some time before we even start to have some very good trends. As you can see, most part of the 1 month and 3 month table is red. The worst hit in the last 3 months have been metals, down 30%, commodities down 21% roughly, IT is down 24%, and it has been seen in past years that whenever any sector is down 25, 30 odd percent, it does throw up a lot of opportunities. So if you are a stock picker, I think several of these sectors should throw up good opportunities. If you are a momentum player, of course, stick with momentum and don't even touch these sectors for now. As I said, very muted day at the end of it. It was nicely up. Small caps were also up almost 1%, but at the end of the day, it was pretty much flat. The weekend investing strategies also were up nicely, but and by the end of the day, they were up mildly, and some even losing ground at plus to minus 0.5% on most strategies. The heat map for the day, again, some gains in some FMCG stocks. Main losers were IT stocks here. You can see TCS, Infosys, Wipro, HCL Tech, everything is down here. And ITC also, after a good run up, has lost some ground here. Banking stocks were down as well, and we have some oil marketing companies, etc., also losing ground, along with some consumption and auto stocks, which were also down. So it may be just a rest day, or we may have hit some sort of an intermediate top in this bounce. I think it's difficult to say, but 16,000 is now a good level, a good resistance to the market, and beyond 16,000 we should see a flurry of a few hundred points if we go there again. But I think 16,000, 16,020, whatever was the top today, will remain a top for many sessions. In terms of top gainers, LG Equipment, AstraZeneca, both were up 8% despite the fall. Asahi India and Soba, along with Gujarat Fluorochem, were up almost 6 to 7%. In terms of losers, RBL Bank was top loser at minus 7%. SRF losing 6%. Oil India continues to bleed 5.5%. Aptus Value and Dilip Buildcon also down about 5% each. The major event of the day, if you can call it, was a new high on the USD INR. This graph shows 79.22, but I think by the end of it, it was above 79.40 or maybe 79.35. So the US dollar is getting really strong, and you can see how quickly we have gone from 72 to 79. So in 1 year, from June 2021 to July 22 now, just about 1 year, we've gone from 72 to 79, and that's a 10% move in just 1 year. So currency, if it is going against you, can be a major dent to your portfolio as measured in global currencies, and you must insulate somewhat using either international stocks or using assets which are priced in other currencies like gold, for instance. Dollar index, as I said, the king dollar, as they call it, is just gaining ground very rapidly. From 90 levels last June, it is now at 106, and it is at a decadal high or a multi-year high, and we don't know where this stops. It goes to 120, it goes to 130. Till such time that the dollar is rising, I don't think there will be inflows into emerging markets at all. In fact, till such time that the dollar is rising, there will remain outflows as money gets reshuffled and moves into the stronger dollar markets, where dollar is now yielding much more than before, and the stronger dollar helps the change in portfolios between equity and debt, where money moves out of equity and goes into debt, and more so between emerging markets and mature markets. So this is our, if I can call it, the king villain for the Indian market and for the Indian currency, until you can see a lower low, lower high, lower low sort of formation somewhere. This is not going to let you sleep in peace. So this is something that we need to watch, and once we do find that the dollar has stopped, in case we do find some formation like that, then of course we can go more aggressive on the emerging market equities. Another insight here was from Japanese experience. So while Japan is extremely unique in what it has done over the last 30 years, many countries may go this way, if not exactly this way, somewhat similar, where the central banks keeps buying the government bonds and sort of corners that market, and nobody else is buying those bonds. So you are creating money and buying those bonds yourself. So what has happened here is that, let's say if you were born in Japan and you are today my age, around 50, and let's say you started investing 30 years back at the age of 20. So you would have started somewhere here when the Nikkei was 16,000, and your entire life, the last 30 years, has not seen any great moves in equity. So your first 10 years maybe, it was range bound, and then in the next 10 years, you actually lost big money, almost 50% of whatever you put in. And only in this last 10 years have you seen, maybe 3x of this bottom point. So overall, you would have made some money. uh, but nothing really that would have bolstered your confidence in equity markets. And you would have looked at other markets, maybe real estate, gold, overseas equities, cryptos, what have. So we are very fortunate that in India we have seen the kind of growth in the last 30 years. If you see the Indian chart from 91, it is like a hockey stick up, going up. So we are very bullish on equity. We have seen the growth. We know that more growth is coming. And that is, I would say, our really good luck that we are born here and we are trading this market or investing in this market, which is giving us this huge opportunity. So if you are, born in Japan, you may not be loving equity as much. But if I will show you the gold chart in yen, you will not believe me that it is like a hockey curve going like this. So if you had put even 10-20% in gold in yen as a Japanese investor, it would have beaten your equity returns by far. So while in India that is not the case, equities has done better than gold. But what I'm saying is any country can go through a phase like this where you have nothing going on in equity markets for 5-10 years. You go on into deep recession. Hopefully India will never, let me not say never, but in the next few decades at least, will not go through that phase because we have some inherent growth in our system and we have a lot of catch up to do to a lot of other more mature markets in the next 20-30 years. So again, coming back to the point that we are fortunate that we are trading this market, we are investing this market, we are at the right age, at the right time in this market. So make the best use of it and create your strategies to make money off the market. Now, another thing that I wanted to talk about, which I didn't so far, was the high inflation. So we'll take an example of Turkey. Turkey is currently in a 70-80% kind of inflation environment. So inflation is 70 to 80% right now. That means what was available for 100 liras last year is now available at 170. That's the kind of inflation that is happening. And of course, salaries and wages are not keeping pace with that. So with every year, you are losing ground. So what I hear from people, and I had some friends from my business school who were Turkish folks, they used to tell me that, as soon as we get some money in Turkish lira, we run to the bank and change it to dollars. Because every day lost holding Turkish lira is money lost. That is the kind of situation that they are living in, and that can happen to many countries. We have seen this happen recently in Russia. We've seen this happen in Sri Lanka, Nepal, Bangladesh. So no country can really say that this won't happen to them. So again, the point is that even if you have very high inflation, and we know that equities with less debt and more market share and moat and all those kind of things, that will help those strong brands to sustain. However, equities will go into a lull in high inflation environment, that is for sure. It'll maybe grow at less single digit growth rather than high double digit growth. So you need to have your eggs distributed in various baskets, whether it is real estate, whether it is gold, whether it is overseas assets. The example that I'm showing here is of gold for Turkish lira. And you can see that in just the last 5-7 years, those who were sitting with gold in lira have seen their fortunes jump up 6x, 7x, 8x in just 5-7 years. Of course, lira has also dropped a lot. So had they held dollars, it would have been maybe like 4x or 5x. Or had they held stocks, it would have been lower than this, because stocks in lira terms or in dollar terms have not done so well in this high inflation period. But real estate may have probably done equally well as the as the gold gains. So again, the distribution of assets in a high inflation period needs to be real assets, commodities, and maybe extremely good uh, low debt companies in the equity markets. Another insight was there today on Twitter from Mr. Sahil Kapoor, and he shared this chart of the 8 core industries of production, coal production, crude oil production for India. And it seems that the monthly production levels, the index, has hit all time highs. So, that kind of cement production, electricity production, steel production. So that suggests that all is hunky dory when it comes to the main economy, and in terms of the production levels. And stock market, of course, is a very different animal than what's happening on ground for some time at least. And if this is true, and we can have a few more months of data to confirm this, if it is true that the economy is running at full cylinders, full cylinder steam ahead, then the market will have to follow that. I mean, I don't think the overseas headwinds will be able to keep it subdued too long if the economy is running on all cylinders. So that is a sort of ray of good hope in the market, that the market internals or the companies are doing well, the demand is doing well, and hopefully there will be some divergence that we will see in terms of the markets from international markets at some point, where the investors may be forced to say, foreign investors may be forced to say that India is no longer too expensive. Right now the common refrain is that India is very expensive, so let's sell more in Indian market. So this is all I had for today's daily bite. Thank you so much for watching and appreciating these videos. Please do like some of these videos, which you do. And the biggest help that you can do to me is to share these videos with your friends or family who may benefit from some market commentary in terms of their investing. So thank you so much.